Good morning, ladies and gentlemen. My name is Dereck Blair. I'm president and founder of Caprock Financial Group. And I want to thank you for joining us this morning. This is Caprock Wealth and Wellness. This is the Caprock Blueprint to a richer, more balanced life. And I want to thank you for taking the time to join us this morning. Our office number here is 806-749-7870. My email is Dereck, D-E-R-E-C-K, at caprockfinancialgroup.com. If you have any questions, you have any concerns, anything you'd like to visit about, give us a call. I greatly appreciate the questions and the reach out we have been receiving from this show. So I want to thank you for everybody for doing that. One of the things I want to talk about today that's we've been getting a lot of questions about, a lot of concern lately is life insurance, about just kind of what does life insurance do and where does it fit? And I'll just be honest, life insurance, I'm a big fan of it. Depending on how you're putting your plan together, kind of what your goals are, life insurance has changed. Life insurance has drastically changed over the years to what it can do, what it is, and what the benefits can be. Back in the day, it was all about the death benefit. As I'm going to put some money in, if something happens to me, I get a death benefit. It goes to my family. But the companies have changed so much; they've gotten smarter about how they can do this. And what life insurance offers now is not only the death benefit, but they can build the cash value. And when they build that cash value, you're looking at about 100% tax free when taken correctly, when built correctly. Then you can build a tax-free retirement. And anytime we can get the IRS out of our pockets, I'm always a big fan of that because I really don't like the IRS in my pocket when I go into retirement. And so with these companies changing the way they've done this, using the correct tax codes, we can get a tax-free retirement. That's a big benefit for our clients. Something else these things have done and they've changed is long-term care. We're going to dive into long-term care because I'm a big believer in it. I'm not a believer in putting money where I might not get a return, but with life insurance, having long-term care built into it, you're going to get a return. And so we're going to talk about that too. But overall, it's just how life insurance has changed so much about the different types of life insurance that they offer and what's going to be best for you or best for your family because it has changed so much. It is an integral part of our financial planning, on our legacy planning. Not only do we use it for the death benefit play, but sometimes we use it for the cash value play. We use it for the long-term care benefits and basically the dynasty creator of how am I going to leave my money to my children? So these are some of the things that we're going to talk about today because the industry has changed so much. So this is kind of what we're going to be visiting about today. So we're going to dive into this about the 4 different types. And let's jump into term life insurance. Term life insurance by far is probably the most popular one because it is so inexpensive. It is basically, I'm putting basically pennies on the dollar. I've leveraged out a death benefit that's 100% tax-free to my beneficiaries. And if something happens to me during that time frame, my family is going to get that leveraged out death benefit. So I don't want to sit up here and quote numbers because everybody has a different situation as far as their ratings, as far as their health, and what the company is going to provide. Now, us being an independent advisor, being able to use the largest companies that we have capabilities to work with, we're going to be able to use the best the best products for our clients. But the numbers could be different. So, for example, you could do anywhere from $70 to $100 a month. You're looking at about $1.5 million to $2 million death benefit. That's a great thing for a young family. I personally have term life insurance because when we have a 13-year-old child, when he was born, it was important that if something were to happen to me, my wife and son and our family would be taken care of, and she would be able to continue working. She'd be able to pay off the mortgage, pay off the cars. And if you think about it, it's so important that we do have home insurance. We do have car insurance, that if those things go down, if we get a hailstorm, if we're in a car wreck, those things are taken care of. But what is the number one person in our home that doesn't have insurance? What does that mean for us? So if you have a breadwinner in the house and they don't have insurance and something happens to them, what happens to their family? What happens to the survivors of that family? Basically, it destroys them. I mean, besides the emotional hardship, you also have the financial hardship. So term insurance is a very popular vehicle when we're young, when we can use it for the right situations. Now, one of the big cons about term policies, and some people we're starting to see that quite a bit, where you buy the term, let's say it's a 20-year term, well, that 20-year goes to expire, but yet you still want to keep that death benefit. Those ratings are out the roof. So you go anywhere from I'm paying, $60 to $100 a month. Well, now all of a sudden after 20 years, that thing could jump up to $500 a month, $750 a month, maybe even $1,000 a month. And we see it all the time. The older we get, the more expensive this insurance becomes. So you have to realize term is really just a temporary. I'm kind of renting my insurance. Hopefully nothing happens. Hopefully I've wasted all this money, and that's okay. I've protected my family if something were to happen. And that's all a term does, is kind of protect my family during that young time. It allows me to grow my 401k, my retirement assets, maybe another permanent life insurance policy in the cash value. But the term is I'm basically renting it. So I'm a big believer in term because it's going to protect your family. So for all you young listeners out there, if you don't have some type of life insurance, maybe it's something you ought to look into that knows if something happens to me, I'm going to be able to protect my family financially. And so it's something that I highly recommend, not only for just young people, but for a lot of people. And so it's important that you look into that to see, am I doing the best for me? Am I doing the best for my family? Another type of insurance, when we start building cash value. So what does it mean when we build cash value in a life insurance plan? So basically, when built correctly, and we're building the cash value, depending on whether it's a whole life, whether it's a universal life, or it's index universal life, we're going to build cash value in there. And that might be the goal. And so when we go to take that money out of these policies, that money is going to be 100% tax-free when it's built correctly. So what it means is that death benefit has to line up with that cash value. There's a ratio that the companies have to follow to stay in accordance with the IRS. And so if we do those correctly, we're looking at some tax-free benefit that as we take that money out, it's 100% tax-free. So let's talk about whole life and universal life. Let's talk about the differences, the pros and cons, because those probably have been the most popular for the longest time. The industry's changing a lot, but those have been by far the most popular. When we talk about whole life, a whole life policy is we're looking at a fixed premium. I know what that premium is. I'm going to commit to that premium, and I'm going to pay it for the life of the policy. It provides you a guaranteed death benefit. So if I'm looking at $500,000, if I'm looking at $1 million, if I'm looking at $2 million for a guaranteed death benefit, a whole life policy might be a right play. And then on the top of that, they're going to give you some interest rate growth. They're going to declare an interest rate, and you're looking at some guaranteed cash value growth. A whole life is considered, it's a little bit more expensive sometimes. For the most part, it's a more expensive product, but you have some guarantees built in there. So if you have someone who's a little bit more conservative, who's a little bit more safety, and they like the guarantee part, a whole life is a great way to go because the premiums are fixed. You're going to pay the same amount every year. There's no guessing. There's no ifs, ands, or buts. This is what it's going to be. And then on your cash value, when you're growing, it's growing at a guaranteed interest rate. Now, sometimes you can have potential dividends from the insurance company. If it's a mutual company, you can get some dividends from that. And that's cash value that you could possibly receive, or it can help you with your premium payments. But those are things that you can expect in a whole life policy. Whole life policies are great, but the industry has changed so much. Is there improvements that can be made? And I'm going to argue that yes, there are. And we see that a lot of the times where someone brings us a whole life policy saying, hey, I've had this for 10 years. I've had this for 15. It's not doing what I thought it would do. Can we improve on this? And sometimes, most of the time we can. And so we want to make sure that just like anything in a retirement plan and a financial plan, when you're building it, it has to match up with what your goals and needs are. So that's why sometimes you have to know, you always have to know what product you're investing in and what kind of company you're going to be using. So the whole life, a lot of the times what we hear too are on the whole life is it's expensive. And I will admit they are expensive up front. They do settle down a little bit more at the end, but a lot of the times you're paying for that high death benefit. You're paying for the death benefit up front. And so it is going to be a little bit more expensive, but the fees are built in. And you just kind of know what those fees are going to be inside that policy. A second one we talk about a lot is universal life. Universal life is more of a flexible premium and a flexible death benefit. There are fewer guarantees. Okay, it does depend on the interest rate, but there can be some movement inside those interest rates. Unlike a whole life that has kind of a fixed rate, this universal can have some movement inside there. And these can lapse if they're not properly funded. So you want to make sure that you know what this universal life is going to be. Because if you're not expecting it and all of a sudden your premiums are going to increase, unlike a term where a term is for the policy of that term, it's going to be a fixed rate no matter what. Your whole life is going to be a fixed rate no matter what. That universal life, it can adjust due to the interest rate. So you want to be aware of, do I have a product that could go up in the future? It's based on the interest rates, and growth depends on the market conditions. This is how the policy, that's how you fund the policy, and that's kind of where that growth comes from. Now, the universal life, it can start cheaper, but the fees, the administration costs, those can increase over time. And so something we bought 5, 10, maybe 15 years ago, it can adjust moving forward. It can become a little bit more cost prohibitive moving forward, just like anything. And so it's always important that you know what you're going to get into. The third type or the fourth type of life insurance is the index universal life. And I know as a financial advisor that we're not supposed to be biased towards one product, but I don't mind saying that index universal life by far is my favorite vehicle in the investment world. I think they do such a good job. That is what my retirement is built on. And so the index universal life is by far one of my favorite vehicles. And I'll tell you why. When I went to build my policy, my own policy, I knew that we had a term death benefit. So my term death benefit was pennies on the dollar to get a good return if something happens to me on an index universal life insurance. So basically what I did was I'm keeping my death benefit as low as legally possible. Now, as you build a cash value, you have a death benefit. And to stay tax-free, you have to have the correct ratio of cash value versus the death benefit. Well, for my particular situation the goal was cash value. I wanted to build my cash value as fast as I can, as much as I can, so that when I go to retire, that money is going to be 100% tax-free. So as my death benefit was rising inside my IUL, my index universal life insurance, I had the term, I had my IUL that was building a cash value while it builds a death benefit. The second part of the IUL is the flexible premium. So me being an independent, me being self-employed, you have good years and you have bad years. So when I have a good year, I'm able to put a little bit more into my IUL. If I have a bad year, I can slow it down a little bit, so it's a flexible premium. So for my business owners, my farmers, my ranchers, those kind of people that their income can fluctuate, an IUL is ideal because it is a flexible premium policy. I am not tied to a premium, and it's not set in stone, such as a whole life. Where a whole life, the premium is set in stone. An IUL is a flexible premium. So years that are good, I can put more in. Years that are bad, I can bring it down a little bit. And that's a big, big positive for our clients. The second part of that is when it comes to an IRA or a Roth, you're restricted on how much you can put in. The IRS has restrictions on by what you make, how much you can put into this 401k, how much you can put into an IRA or a Roth. Well, when it comes to an IUL, you can build that how you want to build it. So if you're a high net worth individual, you're making good money, you're not able to contribute to a Roth, the IUL can be a perfect vehicle because you're able to build it how you want to build it. We have multiple clients throughout the year, throughout our time since we've been doing this, that are anywhere from the $50,000 a month range, you're doing $100,000 a year range, $200,000 a year range. So we have a wide array of clients. They're able to build this that matches up with what their income is, more than what an IRA or more than what a Roth can do. So that flexible premium and the IRS not being in our pocket to tell us what to do is wonderful, because I have clients who can build that how it's comfortable for them, not by somebody telling them what they can do. So those two things right there, flexible premium, and you're not told of how much you can put in, you're restricted by how much you can put in, is a very, very good thing. Second part of the IUL, and there's 5 or 6 of them, we can get really deep into this, but the second part is it uses the index to receive growth. So I can use on most of our products, we're going to be using the S&P 500. We're going to use the NASDAQ. We're going to use the Russell. We have some blended indexes. We have some bond funds. So depending on what company we use for that IUL, they're going to have different options of how we can invest that money. Now, one of the things they do, and this goes across the board for all the companies that we use, is they're going to share in the growth with you. They're going to share in what that market does. So, for example, if they have a feeling or if they predict that the market's going to grow 15%, they might put a cap of, let's say, 12% on there. And so what that means is that client has access to 12% growth in that account. Anything over 12%, that company might keep. And those are hypothetical numbers, so please don't hold me to that. It depends on the company. But it's important to know the reason they do that is because when you share in the growth of the market, the company's going to take on the downside loss. So when an index universal life policy, there's no downside loss due to market downturns. So if the market drops 40%, our client's cash value still stays the same. There's no loss. So it's considered a conservative investment. So the goal is, when it comes to an IUL, you just want to hit singles and doubles. That's all you have to do is just singles and doubles. You want to get positive growth every year because you don't have any downside loss. And when you do that over a time frame, 5, 7, 10 years, 20 years, all of a sudden those gains really start to add up. And so a lot of the times people love that downside protection is I'm not volatile. I'm not having to worry about the downside. I like that being conservative. So that's a big gain for a lot of our clients. A third part of our IUL is when we go to take the money. So basically what you're doing is it's taking a loan. So when you go to take that money, you don't have to be 59 and a half. If you take out your 401k, you take out your IRA, you take out a 403b, pre-59 and a half, the IRS is going to penalize you. They're going to say, hey, you get a 10% penalty, plus you have to pay these taxes. When it comes to an IUL, we can access these funds at any age. So right now I'm 48 years old. If I felt like I wanted to retire before 59 and a half, I can access those funds and there's going to be no penalty because basically what I'm doing is I'm borrowing my own money. I'm just saying, hey, I'm taking a loan. I'm telling the company, I'm telling the IRS, I'm just taking a loan. I'm borrowing my money. And so there's going to be no penalties for taking it pre-59 and a half. So going back to the business owners, going back to the farmers, when we have a situation like this and someone is borrowing their own money, borrowing their cash value, and there's a system out there, I think it's called Be Your Own Bank. I've read into it a little bit. But basically what you're doing is you're borrowing your own money. You're paying yourself back if that's what you choose to do. If you don't pay it back, it gets taken off your death benefit in the end when you pass away. But you always have access to that cash value. And so for a lot of our clients that are in those kind of situations as a business owner, when they want to borrow that money, they can. There's no penalties, and they're able to use that to, finance more buildings, to increase their business, to hire more people, whatever they choose to do. But that cash value is just a very nice feeling that I can get to that anytime I want to. Or when I'm ready to retire, I'm going to start taking a monthly benefit. I'm going to start helping me supplement my income with my retirement, with my pension, my 401ks, whatever else I have. We want to look at that to say, hey, I can start taking this money 100% tax-free. So again, that's just talking about the IULs as far as it's a flexible premium. You can build that cash value tax-free when it passes down tax-free. Now, at the same time, when I mentioned earlier that I have a term, I'm building my IUL for the cash value. When that term expires at year 20, my cash value and my death benefit has rose to that amount of what my term is. So what I'm trying to do is get the most bang for my buck, that I have the term death benefit that's very high at a low cost. I'm building my IUL that has a cash value and a slow rising death benefit so that when that term policy does expire, I've replaced it with my IUL and I'm not having to pay those increased premiums on a term policy. So you try to work the system both ways to do what's best for your family, to do what's best for you, to do what's best for your legacy. Now, when it comes to cash value life insurance, is it age restricted? And we do hear that a lot, that I might be too old. Am I going to pass the physical? You have to look into each person's situation, because sometimes these companies will come out and say, hey, I will take someone with cancer. I will take someone with diabetes. These companies are changing, And so they're always looking for different demographics. And as Caprock Financial, being an independent advisor, being able to use different companies, that helps us with our clients get the best product for them that's going to match up what their needs are. So let's take a quick break real fast. We're going to come back in. We're going to jump a little bit more into the IUL and put them into basic terms of how this can be used every day. Okay, we're back. Again, this is Dereck Blair, President and Founder of Caprock Financial Group, and you are with Caprock Wealth and Wellness. This is the Caprock Blueprint to a richer, more balanced life. Our office number here is 806-749-7870. And today we're talking about life insurance. We've covered a lot. We've covered term. We talked about universal, whole life, and then we're talking about index universal life. But when it comes to life insurance, it's just never a one-size-fits-all. If I had 100 people walk into my office, there's no possible way that I could put 100 people in an index universal life insurance because everybody's situation is different. Everybody has a different goal. Everybody has a different need. And it comes down to just so many different things about life insurance can be a huge part of a retirement plan, but it's just not a one-size-fits-all. And so that's why it's so important for us as an independent that we have all these different choices that we're going to be able to build the right plan for the right person. Something else when we talk about life insurance, number one is going to be tax-free, but the conversion process. We see a lot of clients these days that have worked their whole life. They're ready for retirement. We have these assets that are in a 401k, they're in an IRA, they're in a 403b, they're in a qualified account, which means I have not paid the taxes on them yet. I don't want to use the money right now, or I don't want to use the portion of the money right now because I want to build a legacy, or I want to be able to use this money down the road. And so what we're doing a lot of right now are the conversions of a taxable vehicle, switching them over to a tax-free vehicle, such as an IUL, for the right reasons. So I recently had a couple come in, nurse, just all around great couple, just really neat. And one of the things that was really important to them was building something for their granddaughter. She's the apple of their eye. She loves them to death. They love her. And they wanted to build something from her. And so they had this certain amount of money that was going to sit in a qualified account. The goal was to get growth. The goal was we just want to let it sit there. We're going to pass it down to her. But one of the things they didn't realize was if you're passing money, a qualified account, down to a non-spousal beneficiary, they have to spend that money within 10 years. The IRS wants to collect those taxes, and she would have had to spend that money in 10 years. And so we're going to use a round number of, let's say, $500,000. So let's say they had qualified money of $500,000. They just wanted it to grow. They were going to pass it down to their beneficiary. That's great. But what we looked into was a conversion process on that $500,000 of being able to leverage out into an IUL, of getting a higher death benefit that's going to be 100% tax-free. Now, a lot of the times what we see is when we do this, we're going to get a higher death benefit amount than what we expected. On that life insurance amount, on the death benefit amount, is also going to be the long-term care benefit. So when it came to this couple, not only were we going to leverage this money out for life insurance for the granddaughter, we were going to have long-term care in play for the couple right now. Now, both very healthy, very active. And the numbers are, if you're a healthy person age 65, there's a 74% chance that you will need long-term care. But as a financial advisor, that means to me there's a 26% chance that you don't. And I'm not a fan of putting money towards something that I'm not going to get a return on. So for this particular couple, when we use the IUL for them, one in her name, one in his name, we're funding a death benefit for that granddaughter, but at the same time, they have long-term care if they need it. Worst case scenarios, they need it, they're going to be able to use it, and they're not having to pay extra for that long-term care. These companies have gotten really smart about long-term care because it is so prevalent now in our baby boomer generation that we do need long-term care. How are we going to be able to take care of them? And so our companies have gotten real smart about that. And so for this particular couple, we were able to leverage out a couple $1 million death benefit, 100% tax-free. It's a win-win for them. Now, it might not be a situation for somebody different, but in that particular situation, it was a great move for them. They're very excited about it. It's a win-win for the granddaughter. So all situations are different depending on what your goals and needs are. That's kind of how you're going to plan it out. And when it comes to our 8 elements of financial control, not only does a life insurance fit into income optimization, it fits into legacy play, It fits into legacy protection. If you were to get in a car wreck and somebody tries to sue you, that's probate protected. They don't have access to those funds because it's a life insurance policy. And it also comes into Dynasty Creator, that how do I want to live my money and where do I want to live my money to? And then the last one, but the most important, is the tax planning. So I'm a big fan of any time that I can get the IRS out of my pocket, I want to do it as fast as possible. I'm all about paying my fair share of taxes. I have no problem paying my taxes. But when it comes to having to pay more than I have to, I don't want to do that. And so a lot of the times when we're able to use these IULs, we're getting the IRS out of our pocket a little bit faster. And when we talk about taxes, this goes back to something I always talk about, that my dad was a farmer, and one of the jobs on my farm when I was growing up out in Shallow Water was during planting season, cotton planting season. My dad would back the pickup up or back the tractor up, and I would hop out and I'd grab those 50-pound bags of seed, and I'd put them in the planter, and my dad would take off. So in the back of his pickup, we had all these bags of seed that could farm this whole place. We could plant this whole place in cotton. But at the end of the year, when it was harvest time, you had to pull those cotton strippers out. You had to pull those module builders out. And if you had a good crop, man, you could have a lot of modules in that field. And so my question is, and what makes sense to me is, do I want to pay tax on the seed that's in the back of my dad's pickup, or do I want to pay tax on the harvest that comes out at the end of the year? And for me, it's a simple thing of, I want to pay tax on the seed. I want to pay tax on the littler amount so that when this big amount comes out, it's mine and mine only. I don't have that silent partner. Because if you do have an IRA, you do have a 401k, you have any qualified account that I have not paid taxes, we have a silent partner. We got someone else that we have to pay that's part of our retirement. And so that's where your RMDs, your required minimum distributions, come in at a certain age, as the IRS says, hey, you have some money, and we want our benefit. We want to be able to pull a little bit of that back. And so you have to start taking it. And so that's why I'm such a fan of the right type of life insurance when it makes sense for our clients. So if you have any questions about life insurance, if you're curious about your policy, and we see it all the time where people come in and say, hey, I've got this policy. I've had it for 15 years now. I really don't know what it's doing. I don't know how it's earning. Can you kind of break this down and let me know if there's something better out there? And we get those all the time. And most of the time we can improve those because our industry in the life insurance has changed so much. It's changed so much that we're able to build that cash value. It's changed so much that we have long-term care on the death benefit. And a lot of the times, even though someone might be older, we can get a better death benefit because we're living longer than ever before. So our actuaries have changed the number that we can get a better death benefit than what we're receiving for the same amount of money. So if you do have any questions about your life insurance, reach out to us. This phone number is 806-749-7870. We'd love to answer any questions you have about life insurance because it's something we really do enjoy talking about. It's something we really believe in inside here at Caprock, and we want to answer any questions you might have. I do want to wrap this up, but I want to let you know July 15th, 6 p.m. at Harrigan's Restaurant here in Lubbock, over off Indiana, we are having a financial seminar. We're going to be talking about some income. We're talking about taxes. We talk about life insurance. It's a fun 45-minute presentation. We serve dinner. If you have any interest in that and getting to know me and kind of what I stand for, more than what the radio show offers, we'd love to have you. Again, that's July 15th at Harrigan, 6 p.m. And you can reach out to our office here to get registered, 806-749-7870. And again, I appreciate you taking the time today. I hope you really enjoyed this. And if you have any questions, reach out. And I look forward to talking to everybody next week. Hope you have a great day, and we'll talk soon. Bye-bye.